Hello all, welcome to Salaried Individual channel. Today we will talk about everything you need to know to start your investing journey. We will start with the basics and then go to the advanced topics that every beginner should know before starting the investment journey. This will help you if you are a beginner or want to take your investment journey to the next level. In every financial post, you might have read about investing and how it can help you to achieve the financial freedom. Everyone suggests that you should start investing as early as possible. But the real question is, where do you begin? What types of investment are appropriate for the beginners? And how do you avoid the common beginner mistakes? So that's why this video is for you who all are beginner in investing. So first of all, what is investing and how does it work? In simple terms, investing is a procedure in which your money makes money. You are essentially putting your money to work so that it can make more money for you. There are a variety of different types of investment, but they fall into two categories. Number one, passive investment. These are investment where you don't have to do anything after you have made them. Your money is invested in a company or fund and you let it grow on its own. The second is active investment. With this investment, you are more involved in the day-to-day management of your money. You might have to do research different companies and pick the ones you want to invest in, or you might want to buy the stocks yourself. So how does it work? How the investing works actually? So when you invest, you are buying a shares in a company or a fund. These shares represent a portion of the company and they give you a stake in its success or failure, of course. As the company grows and becomes more successful, the value of its shares goes up, which means that your investment becomes worth more as well. Conversely, if the company fails, the value of its shares will go down and so will your investment. So what you need to do to start investing? You don't need to be a millionaire to start investing. In fact, you can get started with rupees as little as rupees 100. But there are few things you do need. The first is an investment account. We say that as an demat account in India. This is where your money will go and grow over time. You can open an account with a brokerage firm where you will buy the shares or the mutual funds. In India, some of the good brokerage firms are Zerodha, Grow, etc. The second is the knowledge. You need to understand the basics of investing and how the stock market works. This video will help you teach the essentials, but there are plenty of other sources of information out there too. The third is time. It takes time to grow your money, so be patient. You won't be a millionaire overnight, but with dedication and patience, you can create long-term wealth for yourself. So what are the common investment strategies? When you are starting out, it's important to familiarize yourself with the different investment strategies that are available to you. That way, you can make an informed decision about which one is right for you. So here are the most common investment strategies. Number one, buy and hold. This is when you buy the stocks or other investments and hold on to them for the long term. This strategy is often used by investors who are looking for stability and security over short-term gains. This is also good for people who who want to give less taxes to the government, because the long-term capital gain taxes are only 12.5% in India, whereas the short-term capital gain tax is 20%. Number two is the active management. This is where investors or money managers attempt to outperform the market by buying and selling investments regularly. That is short term. Then the third is value investing. This strategy involves finding stocks that are trading at a lower price than their intrinsic value. Investors who use this strategy believe that these stocks will eventually increase in value. Number four, momentum investing. This approach focuses on stocks that are experiencing rapid price increase. Investors who uses this strategy believe that these stocks will continue to rise in value. Number five, growth investing. This strategy invests in companies that are expected to experience high rates of growth. These companies are often in new or emerging industries. Number six, dividend investing. This strategy involves investing in stocks that pay regular dividends. These payments can provide investors with a steady income stream or passive income. Index investing. Number 7, index investing. This is when you invest in an index fund, which is a basket of stocks that tracks a particular market index. This strategy is often used by investors who are looking for a simple and low cost way to invest in the stock market. You can check out my previous video where I have invested in the ETF, which is nothing but an index investing, where I have gained 16% returns in the last 1 year. The link is in the description. Number 8, exchange traded funds. This is when you invest in a basket of assets that are traded on an exchange. These baskets can include stocks, bonds, and commodities. This is again the same like an index investing. And number 9, mutual funds. This is when you pool your money with other investors and have it professionally managed by a money manager. This approach gives you access to a wide range of investment. Note, how this is different from index investing is that we here in mutual funds we are talking about the active mutual funds investment and not the passive funds. For the passive is same as index investing. And number 10, real estate investment trust or REIT. This is when you invest in a company that owns and operates income producing real estate. These companies often pay out regular dividends to shareholders. Next is choosing the right investment platform. That is the brokerage firm. Like there are many. Say for example, we have Zerodha, Grow, Dhan, ICICI Securities, etc. If you are new to investing, the process of choosing the right investment platform can be daunting. To make the best decision for your needs, it's important to consider fees, investment options, and the user experience for each platform. There are few key things to look for when choosing an investment platform. First, you will want to consider the fees charged by the platform. Many platforms charge a flat fee per trade, like rupees 20 or some percentage for per trade, while others charge a percentile of the total investment, that is 0.05% of the total investment. Make sure to compare the fees charged by different platforms to find the best deal. Next, you will want to consider the investment options offered by the platform. Okay, so many platforms offer a wide variety of investment options, including stocks, bonds, and mutual funds. Make sure to choose a platform that offers the investment options that best meet your needs. If you want to only invest in a mutual fund, then you can go with direct also. But if you want to have both at one place, then you can go with grow. Finally, you will want to consider the user experience of the platform. The best investment platforms are easy to use and provide a variety of features such as real-time codes and charts to help you make the best investment decisions. When choosing an investment platform, make sure to consider fees, investment options, and user experience to find the best platform for your needs. I personally use Grow and Zerodha. Grow for most of my mutual funds investments, whereas Zerodha for most of my stocks purchases. Next is knowing the risk involved in investing. It's important to be aware of the risk associated with the investing, as they can have a significant impact on your returns. The three most common risks are market risk, inflation risk, as well as liquidity risk. Market risk refers to the uncertainty of stock prices and is based on factors such as economic conditions, industry trends, and company performance. Inflation risk is the effect of changes in inflation on the value of your investments over time. Liquidity risk is the possibility that you may unable to withdraw your funds quickly enough due to the market conditions or lack of buyers for your investments. It's always a good idea to speak to a financial advisor before investing, as they can help you understand the risk involved and provide guidance on how to best manage them. This will ensure that you are making informed decisions when it comes to investing and preparing for your financial future. Now you are ready. You know the basics, and now you are ready to start investing. So it's time to get started and grow your portfolio. To do this, you have to follow some basic steps. Number 1, Make sure you have the clear financial goal in mind and an understanding on how to reach it. In other words, figure out what type of investment will help you meet the goal the best and set a timeline for when you want to achieve it. For example, if you have a short term goal that is 1 to 2 years, you should not invest in the equity because that can decrease in your value based on the market condition. So you should always go for the uh, debt mutual fund, or you can go with the FT that can give you the return for 1 or 2 years, because you don't want to lose the money for your short term goals. Whereas if you are investing for a long term, say for example 10-15 years for your long term goals, then it's better to with the equity. And as also, you should not go with 100% equity. It can be like 70-30, 70% equity and 30% debt, whereas most of the conservative people go with 50-50, that is 50% equity and 50% debt. So so you have to figure out what type of investment, what type of goals you are looking for, and based on that you have to invest your money. Number two, choose a broker and open an account with them, that is a demat account. There are several brokers out there, and do your research to find one that meets your needs and requirements. I personally use Grow and Zerodha. Number three, do your research in depth. Once you have chosen a broker, it's time to start researching investments and the stock market as a whole, so that you understand what your options are before investing. Number four, make trades. Once you feel comfortable with your chosen investments, it's time to start investing in them so that you can grow over time. Number five, keep track of your performance and make adjustments if needed as you continue investing over time. It's always important to stay up to date on how investments are performing so that you can make the adjustments or reallocate the assets as needed for optimal performance. So, in short, at last, I just wanted to say that getting your finances in order can be a daunting task. Okay, but it's crucial if you want to achieve your financial goals. And one of the best way to get started is to start investing. Okay, so what you are waiting for? Start investing today and unlock your financial potential. Thank you for watching. Please like, subscribe, and share the video if you have liked it. Thank you.